Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your September 2019 market update. Well, I wanted to start today by showing you a picture of where we've been over the last few years in the markets. Year to date, investors have seen very nice returns in their accounts with the S&P 500 index, which is a measure of the performance of large cap domestic stocks, up double digits year to date. But if you look over a longer time horizon, it's been more of a difficult market in which to invest. And I thought by giving you a picture of this, that could help you put some things into context. So what this chart is showing is the S&P 500 index, which again measures the performance of the largest stocks in the US. And what I want you to do here is zone in on that yellow horizontal line on the top right-hand side of the chart. And what you can see here is that since the beginning of October of 2018, the markets have virtually gone nowhere. As of the end of September, once you include dividend, the S&P 500 was up a little over 4%, but we've had a rough start to October so far, and we have actually dropped below where we were last year at the same time. The interesting thing here is that if you look at those green zigzag lines there, what that is showing is every move of at least 5% from a recent high or low. And what this does is it helps to highlight for you what a volatile period it has been for the markets. If you count the number of reversals in the market of at least 5% over just the last year, so just where that yellow horizontal line is, it will sum to 11. So 11 times the last 12 months, the market has swung by at least 5% one way or the other, making this an incredibly volatile period in which to invest. Now, two issues have really dominated the headlines over the last year: trade and interest rates. And so much so that all of those major gyrations that you see there, those green zigzag lines in the markets of last year, can be linked to one or both of them. Now, since my last market update, there has not been much additional news on the trade front. China is meeting with the U.S. later this month to continue negotiations. However, a resolution still seems a bit down the road in terms of trade and coming to a consensus there on how we can move forward. On interest rates, the Federal Reserve lowered interest rates again in September. So let's take a look at what this has done to the bond market. So while the equity markets have been relatively flat over the last year, when you exclude dividends, bonds have rallied because interest rates have come down so much. This chart shows the iShares Barclays Aggregate Bond ETF, which measures the performance of investment-grade domestic bonds. And the green zigzag lines on this chart show moves of at least 3% from a recent high or low. And what you can see here is that since last year, where that yellow line starts, since last year, the bond market has performed quite well and has provided a really nice diversification benefit to investors. Over the last few years, I've had many clients ask, well, if interest rates are so low, what is the benefit of even investing in bonds? And the benefit is that when interest rates decline like they have, you can still get a nice return profile. And so this really is a picture of how much diversification can benefit you as an investor. Now, interest rates have declined due to a more cautious view on economic growth going forward, both here and abroad. The Federal Reserve has been cutting interest rates, and central banks around the world have been cutting interest rates as well. And I touched on that in my last market update. Basically, as central banks around the world cut interest rates, even though our interest rates are still low relative to our history, they're still higher than what investors abroad can get in their own fixed income markets. And what that does is that increases demand for our bonds, further pushing down the yield and increasing prices for investors. So putting this into numbers for you, over the previous 12 months, if you look at the navy blue bar there, bonds as measured by the Barclays Aggregate Bond Index have returned 10.3%. So a very nice return profile for more conservative investors. On the equity side, we'll start the left-hand side of the chart there. Yellow, which is the S&P 500 large cap stocks, once dividends are included, and this is through September 30th, the S&P was up 4.25. Domestic small cap stocks, the red bar, have not done nearly as well as large cap. Over the last year, they're down 8.89%. The MSCI ACWI ex-US, which is a measure of performance of international and emerging market stocks, are down 1.23%. And a lot of that decline comes from a rising dollar. The dollar continues to be very strong, which depresses returns for domestic investors in international securities. And the Bloomberg commodity index on the far right-hand side of the graph there, the green bar, is down 6.57% over the last year. So it's certainly been a difficult period in which to invest. However, what I hope you can glean from this is that this is why we diversify your portfolios by having an allocation to bonds and a bit of an overweight to domestic large cap stocks that can really help keep your return profile in line with your expectations. So the news dominating headlines as of late has been the impeachment inquiry against President Trump. And impeachments, as you know, are rare events. And I've had some questions surrounding, well, what does this impeachment look like in terms of, or what effect, rather, would this impeachment have on equity markets? And impeachments are such rare events, and market outcomes have been very different. And so we have to look at each of them in context. So for example, Nixon's impeachment process began shortly after the first oil shock in late 1973, and that resulted in a recession and rising inflation. Nixon resigned in August of 1974. So in the context of that impeachment process beginning, you had a very different type of economic backdrop. Clinton's impeachment in December 1998 was almost a non-event for the markets, as stocks and credit had already experienced the Asian crisis, the Russian default, and the collapse of long-term capital management that summer. And markets rallied shortly after President Clinton was acquitted. Now, impeachment can take months to unfold, so this is yet another event that will be hanging over the market for some time. Our base case scenario is that the Democratic-led House will impeach President Trump, but once it moves to the Senate, a conviction is unlikely given that Republicans hold 53 seats and a 2/3 majority is required. Of course, the wild card here is what the impact will be on the elections in 2020, which could really yield a myriad of scenarios impacting issues from taxes to healthcare to trade, depending on how the races end up playing out for the White House, the Senate, and the Senate. So while the impeachment proceedings have injected yet more drama into the markets and something else for investors to be concerned about, overall, there's little justification for making changes to our overall asset allocation for now, because there's so many question marks as to what could actually happen going forward with this impeachment inquiry. Now, going forward, we do believe that we are positioned well for an environment of slowing global growth and continued uncertainties on many fronts. So I just spoke about the impeachment inquiry. We're certainly watching that closely, but again, the impact on the market is really context specific. There's really no historical precedent that we can point to say if President Trump ends up being impeached, this is what will happen to the markets. You really can't do that when it comes to political issues. So, but we do have this uncertainty hanging over the markets about the impeachment for a while here. The Brexit crisis continues. There's really no updates on that front. Prime Minister Boris Johnson is still trying to get the Brexit through in the UK, and we hopefully will have some more clarity around that over the next few weeks. The riots in Hong Kong, which I've talked about on last market updates, continue. Remember, Hong Kong is Asia's financial hub. And this week, the first person that was a rioter was shot in Hong Kong with the use of live ammunition. So there has certainly been an uptick in violence on that front. And Hong Kong just this week announced they are loosening restrictions on the use of force in an effort to stamp out anti-government protests. And so those protests continue. They are getting more and more violent, and Hong Kong is now able to use more force against the protesters. That, again, is something we're watching closely, given that Hong Kong is Asia's financial hub. As I mentioned earlier, the trade war with China continues, so there's still some uncertainty about that, and policy uncertainty continues around interest rates. Now, since the beginning of October, we've had a bit of a fall in domestic markets. The manufacturing numbers that came out this week were quite poor, and they point to a bit of a contraction in manufacturing. And so we do think that growth will continue to slow, both domestically and abroad. And how the Federal Reserve reacts to that surrounding interest rate policies is yet to be seen. However, Fed Chief Powell has made the statement that they will continue to lower rates as necessary to preserve the economic expansion. So really overall, the last few months we have been, from a portfolio perspective, we have been dialing back risk in our multi-asset class portfolios, and we've added securities to the portfolios that can provide uncorrelated returns to both stocks and bonds. So given the number of uncertainties facing the markets right now, we are positioned well going forward. We will continue to assess the economy and the markets on an ongoing basis and make changes to the portfolios as warranted. We thank you for your continued confidence, and please reach out to us with any questions you may have.